Basic terms for company analysis. When investing in stocks, it is important not only to look at whether a stock price is rising or falling, but also to analyze how well the company is growing, how much profit it is generating, and whether the current stock price is fairly valued compared to the company's actual value. The most basic indicators used to analyze a company include revenue, operating profit, net income, EPS, PER, and PBR. Understanding these terms helps investors evaluate a company's current performance and future growth potential. 1. Revenue sales. Revenue refers to the total amount of money a company earns from selling its products or services. In simple terms, it is the total income a company generates from its business activities. For example, if a company sells products worth $10 billion in 1 year, the company's revenue is $10 billion. However, a high level of revenue does not always mean that a company is doing well. A company may generate large sales but still have low profits if it has high production costs, labor expenses, or operating costs. Therefore, investors should not only look at the size of revenue, but also check whether revenue is growing consistently and whether the company has the potential to continue growing in the future. 2. Operating profit. Operating profit refers to the profit a company earns from its core business operations. It is calculated by subtracting operating expenses, such as production costs, employee salaries, and other business-related costs from revenue. For example, revenue from sales $10 billion, operating expenses $8 billion, operating profit $2 billion. Operating profit is an important indicator because it shows how efficiently a company generates profit from its main business activities. A company may have high revenue, but low operating profit if it faces strong competition or has poor cost management. Therefore, investors should examine whether operating profit is increasing steadily and whether the company has strong profitability. 3. Net income. Net income refers to the final profit remaining after all expenses, taxes, interest payments, and other costs have been deducted. A company may generate operating profit, but it still needs to pay taxes, interest expenses, and other costs. The amount left after all deductions is called net income. For example, operating profit $2 billion, taxes and other expenses $500 million, net income $1.5 billion. Net income is one of the most important indicators because it shows how much money the company actually earns. After all expenses are considered, investors should check whether net income growth is sustainable or whether it is caused by temporary factors. 4. EPS, earnings per share. EPS stands for earnings per share and shows how much profit a company generates for each outstanding share. The formula is EPS net income, number of outstanding shares. For example, net income 1 billion, outstanding shares 100 million shares, EPS $10. This means each share represents $10 of company earnings. A higher EPS generally indicates that a company is generating more profit for shareholders. Companies with consistently increasing EPS are often considered to have strong earnings growth potential. 5. Peer price-to-earnings ratio, PE ratio. PER, also known as the price-to-earnings ratio, is a valuation indicator that shows how expensive or inexpensive a stock is compared to the company's earnings. The formula is PER stock price, EPS. For example, stock price $100, EPS $10. Per 10. This means investors are paying 10 times the company's annual earnings for the stock. Low PR. A low PER may indicate that a stock is undervalued compared to the company's earnings. However, it may also mean that investors have low expectations for the company's future growth. High PAR. A high PER may indicate that the stock is relatively expensive. However, companies with strong future growth potential often have high PERs because investors are willing to pay more for future earnings growth. Therefore, PER should not be viewed alone. Investors should compare it with industry averages and the company's future growth prospects. 6. PBR, price-to-book ratio, PB ratio. PBR, or price-to-book ratio, shows how the stock price compares to the company's net asset value. In simple terms, it helps investors determine whether a stock is trading above or below the value of the company's assets. The formula is PBR stock price, ASH book value per share, BPS. For example, book value per share $50, stock price $100, PBR This means the stock is trading at twice the company's book value. Low PBR. A low PBR may suggest that a stock is undervalued compared to its assets. However, it may also indicate that the market has low expectations for the company's future growth. High PBR. A high PBR may mean that investors are expecting strong future growth and are willing to pay a premium for the company. How to analyze a company using these indicators. When analyzing a company, investors should not rely on only one indicator. It is important to look at multiple factors together. Revenue shows whether the company is growing in size and expanding its business. Operating profit shows whether the company is efficiently generating profit from its core operations. Net income shows the actual profit remaining after all expenses. EPS shows how much value the company creates for each share. PAR and PBR help determine whether the current stock price is reasonable compared to the company's value. In conclusion, successful company analysis requires looking beyond stock price movements and evaluating business growth, profitability, financial stability, and valuation levels together.